To the market report on the 19th of June. Right, the news events that's coming up. Today, I want to discuss about when will the stock market crash. We have been seeing the S&P 500 making the all-time highs. We have seen NASDAQ making all-time highs. Same with the Dow Jones. So what are the signs that that would put the hold on investors, those that the informed investors, put the hold there and be wary rather than putting a lot of money in and keep on buying up the whole thing? When should they be wary? I'm not saying that the market will come down immediately straight away, but you have to be careful when these signs are out. So what are those signs, right? That's what we'll discuss in today's sharing. So firstly, it's essential to understand what drives the stock market upwards. Typically, the stock market thrives in an environment characterized by strong economic conditions. We all know that. This includes a healthy labor market with low unemployment rates and rising wages, as well as positive economic indicators such as increased consumer spending, robust industrial production, and overall GDP growth. Now, these factors collectively indicate a growing economy, which boosts investors' confidence and drives the stock market higher. A critical component backing this upwards trend is the consistent earnings growth reported by companies from quarter to quarter. When companies demonstrate increasing profitability, it reassures investors of their financial health and future potential. Now, this earnings growth is often a result of increased sales, increased operational efficiencies, and expansion into new markets. As companies report positive earnings, their stock price typically rise, contributing to the overall market growth, right? So, in essence, the market is flooded with good news, creating a virtuous cycle where positive economic data and strong corporate earnings reinforce each other. Pushing the market to new heights during such periods is common to see stock markets indices like the S&P 500 or the Dow Jones Industrial Average trading at or near all-time highs. However, the question arises, how can an investor predict when the stock market has reached a point where caution is warranted? Now, this is what we want to discuss today. A method is to look back at historical patterns. Historically, just before a significant market correction, the market often exhibits a counterintuitive behavior where it begins to react positively to bad news. Okay. I want to say in very simple terms, bad news is good news for the market. Now, this phenomenon occurs because investors start hoping that negative economic developments, which prompt central banks like the Federal Reserve to implement favorable monetary policies such as cutting interest rates, right? Now, this scenario where bad news is perceived as good news creates a disconnect between the stock market and the underlying economy. Essentially, it suggests that if the economy deteriorates, the stock market, which should ideally reflect economic health, might perform better due to expectations of policy interventions. Okay, so they're hoping for bad news, so there's intervention, and with this intervention, it helps the market, it boosts the market. So currently, we are witnessing a similar situation. The market is anticipating that the Fed will cut interest rates to stimulate economic activity. However, the Fed typically lowers interest rates only when certain conditions are met, such as worsening labor market characterized by higher unemployment, stagnant wage growth, and a decline in retail spending. These conditions indicate economic distress, prompting the Fed to act to support the economy. At present, while there are challenges with aggregate demand, such as reduced consumer and business spending, the labor market remains relatively strong, right? There has been a significant increase in unemployment or a notable slowdown in wage growth. Therefore, the conditions required for the Fed to cut rates have not yet fully materialized. There hasn't been so far. We are not seeing a significant increase in unemployment. Nothing yet. or a notable slowdown in wage growth there. Okay, so far conditions are still okay. When we start seeing negative trends in job data, such as rising unemployment, declining wages, it could signal the beginning of a market correction from there onwards. This would mean that the previously counterintuitive behavior of the market reacting positively to bad news will then shift. At this point, bad news will indeed be perceived as genuinely negative, reflecting the true state of the economy and likely leading to a decline in the stock market. So to sum things up, when things don't make sense, the economy, good news, good economic data, we should see the economy getting better. But when you have the hope, investors hoping that we get bad data so that that's intervention, this is not something that is really, really good, and it doesn't make sense, to be frank. Okay, so because good news, good economic data pulls the economy up, not the other way around, right? So right now, the moment we have continuous weakening of job data, and rising unemployment, that will be the sign. So we are not there yet. We'll just have to wait a bit, but I'm just telling you, we are reaching a point where you have all this right now, bad news is actually good news for the market already. So be on the lookout for these signs, and we'll be ready when the time comes. Okay, so with that, that's the report for today.